With news, banks now need to include buy now, pay later, and also higher education debts when reporting debt to income ratio, and add in a 0.85% cash rate. It's another blow to potential first home buyers. Well, Matt Gatt, General Manager of Home Loans at Compare Club, says that the change highlights what a grey area it's been until now. Now, some banks, he says, have already included buy now, pay later as an ongoing debt, while others have treated it as an expense. And it's been confusing for people when it comes to purchasing a house and getting a mortgage approval. Well, APRA has now signalled to lenders they must also consider buy now, pay later as an ongoing debt, as well as higher education loans. And it's a move set to reduce the borrowing capacity for buyers. Joining us to discuss if APRA is tightening its lending policy amid shaky economy and what it actually means is Matt Gatt. Welcome, Matt.
Hi, Michael. How are you going?
Good, thanks. And you?
Good. Yeah, good. Thank you.
Now, what conditions for home buyers, homeowners and home buyers, what are they going to look like for the rest of the year?
Yeah, it's a good question. So obviously there's a lot of change going on at the moment, particularly when you look at the interest rates in the market. So we've been expecting that interest rates would increase this year. I think they've come probably a little bit sooner than a lot expected, and significantly higher than what we were expecting initially as well. So they seem to be rising a lot quicker, which means that budgets for homeowners are going to stretch into the future because there's no end just yet to those interest rate increases. So I guess for homeowners, it's going to be an increase in repayments. So we sort of need to make sure that we're prepared for that we're adjusting our budgets where possible, making additional payments to our mortgage, that sort of thing. For people who are looking to get into the property market, certainly a lot of reports that I'm seeing and a lot of commentary in the market is that the market has started to soften, and in some areas property markets have started to dip a little bit, and that's expected to continue as well. So potentially for people looking to get into the market, it may mean that properties become somewhat more affordable than they have been in the past. But I mean, my view would be that I don't think it's going to be a significant drop off, but there will be some softening of property values.
Yeah. Now, when you say that the interest rate rises came quicker than what a lot of people expected, we actually had the Reserve Bank say no interest rates until 2024. How much has that added into the insecurity or the uncertainty that we're feeling at the moment? Or is it just one of those things that it's just as it is?
That's right. Yeah. So I think off the back of those comments, there probably were a lot of people who took a bit of comfort in that and potentially went out and bought a property on that advice or that indication that rates wouldn't rise for a period of time, and potentially have borrowed more than they otherwise would have. So to see interest rates rising sooner than that and significantly sooner than that, those people who did do that are probably going to see their budget stretched beyond what they had originally anticipated. So the potential downfall of that is that there's people that are going to fall into mortgage stress as a result, unfortunately. But the best thing that everybody can do at the moment is just have a look at what your budget is, what your current expenditure is on your mortgage in particular, and work out what that may look like in 6 or 12 months' time, and make sure that you're prepared for that. So the better that you're prepared, the sooner that you start preparing for that, the better you'll be able to weather those increases in interest rates that are still to come, in addition to what has already come.
Yep. Now, you mentioned mortgage stress, and for the viewers that aren't experts, obviously like you and I, how do we define mortgage stress, Matt?
Yeah, so typically it's people who allocate more than 30% of their overall income to their mortgage. That they are generally the bucket that fall into those that are more likely to experience some form of mortgage stress. And again, in an increasing interest rate environment, that is more likely to occur. And what we've also seen over the last 6-12 months and the last couple of years as well is that the average loan size has increased, where in the past it used to be around the 500,000 mark. That's increased to 600,000. So people have been borrowing more, incomes haven't necessarily been increasing, and so interest rate increases have more of an impact on a family budget than they used to in the past. And so the risk of people falling into mortgage stress is probably a little bit higher at this point.
Right. Now, given these new guidelines that APRA are enforcing with buy now, pay later, will this affect people's ability to refinance, given they say, well, if you want to increase it, now you've got these extra costs. I'm sorry, so we've got to leave you stuck basically where you are.
Yeah. Any lending policy change always has some form of impact like that on people who do hold a mortgage. So buy now, pay later still is a relatively new product in the sense of, you know, banking and that sort of thing. So as you mentioned earlier on, it has been a bit of a grey area from a policy perspective for lenders, and different lenders have considered that type of debt in a different way. Some as an ongoing debt, some as just an expense that they add to the expenses. So the guidelines that APRA have put out around buy now, pay later will start to standardise that across all lenders. So there'll be less leeway for lenders to make their own decision around how they view that from a serviceability perspective. That will have an impact on how much people can afford to borrow based on lending guidelines, and it all falls into the debt to income ratios. And so what people could afford to buy to loan, as far as loan amount goes, say 6 months ago, may be less now if those debts weren't previously taken into account. So as interest rates increase, people who do have buy now, pay later products may not be able to refinance the way that they want to get a better product. And so again, people just need to be aware, if they have these products, what impact that has on their borrowing capacity. And if they don't need it, close it off and get rid of it.
And also, we've mentioned that HECS or higher education fees may be part of it. So if you're a household of two, you could have $120,000 worth of HECS debts quite easily. Suddenly, that goes as a liability as well against you.
Exactly, yeah. So HECS is probably more consistently being viewed as an ongoing debt by most lenders. So it's probably less of a change around HECS. But I guess from that particular type of debt, that does tend to impact first home buyers more, because typically, first home buyers coming out of university, starting their new job, starting to pay that debt off. And so their serviceability then is impacted by having that debt there. And again, typically when people go into a university course, they know that HECS is there and that they can defer the payment of their course fees and so forth, but they don't necessarily understand that becomes an ongoing debt when it comes time to buy a property. So the impact of having that HECS debt isn't felt until they actually want to go and buy a property.
Right. So Matt, given your expertise, what action can home buyers take at the moment, or what should they be taking, given what advice would you give them?
Yeah, so I think it's the same as what I've been saying for a little while, which is there's never a better time than now to review your mortgage. So particularly in an increasing interest rate environment, there are still some really competitive offers on the market. And so for every month, every year that people delay reviewing their mortgage, they're potentially paying more interest than they have to unnecessarily. And it's not just mortgages at the moment. Cost of living overall is increasing. So any saving that people can make on their mortgage, the sooner you make it, the sooner you start making those savings, and the better position you're in to weather those increases in interest rates that are coming. Typically what we see is when people are coming to us to refinance their mortgage, we're able to reduce their rate on average by 0.8%. And that on an average mortgage saves anywhere from $4,500 to $4,800 per year in interest. That's a lot of money back in your pocket every month and every year that you can put towards other expenses and just set yourself up financially.
Yeah. What else can homeowners do to protect themselves from potential and most likely interest rate hikes coming up?
Yeah, so the obvious answer is to look at fixed rate options, right? So you can lock in your interest rate for a specific period of time. That gives you comfort knowing that for that time frame, your rate won't change. Unfortunately, over the last 6 months or so, fixed rate products have become less and less competitive in the market. They are, quite expensive in comparison to variable rates at the moment. So always, I would recommend getting advice around whether that's the right option for you. The other thing that people can do as well is anytime that you have spare cash within your budget, make additional payments to your mortgage now. So whilst you're in a position to do that, make additional payments, build up a bit of a buffer. If interest rates do continue to increase and you find yourself in a position where you are under mortgage stress, at least you've built up a buffer that will help you weather that until you're in a better position beyond that. So they're probably the two things that I'd look at, is reviewing your mortgage now to see what better options there are out there, potentially looking at fixed rate options. And then if you're in a position to make additional payments now, start making those, because that helps you weather increases in the future as well.
Right. Are there any benefits to looking behind the big four banks for your options?
Yeah, definitely. You know, I was reading an article the other day actually that the market share of some of the majors is starting to drop in favour of smaller lenders. And that's because some of their more competitive products that they've gone out to market with in the past are starting to be removed from the market. So there's so many different lending options out there in the market, and you know, typically some of the second tier and smaller type lenders do offer really competitive rates and fee structures in comparison to the majors. What I tend to find is that people are more comfortable with the majors because they know the brand, they're comfortable with who they are, who they're dealing with. What people need to consider is whether that brand is worth paying the extra money that you're inevitably going to pay. So definitely, I would recommend looking outside the majors. There's some really great deals around, but always back that up with some advice around what are the pros and cons and that sort of thing.
Right. And for the Victorians amongst us, state election coming up. Historically, does this have an effect? Will it have an effect in your opinion?
Yeah, so I don't necessarily think it'll have too much of an effect from a lending perspective. What may come from that, which is what we've seen, particularly in New South Wales recently as well, is some reform around first home buyer incentives and potentially stamp duty, things like that. So that will potentially sway voters one way or another around what the different parties are offering from that perspective. And post-election, it may mean that it becomes harder or the same for first home buyers to get into the market and so forth. So from that perspective, yes, it may have an impact. From a lending affordability and that kind of thing, I don't necessarily think that the state election itself will have much of an impact on that.
Now, glad you mentioned the New South Wales one. We've seen their proposal to stamp duty versus land tax.
Yeah.
Do we have an opinion on whether that's a good thing, a bad thing, whether it'll affect prices up or down?
Yeah, so it's interesting. It's relatively new, so the detail is probably still yet to come from the government as well. But I think there's pros and cons to both structures. My understanding is that at this stage, it's for first home buyers, and they can select whether they prefer the current model, which is a pay up front, or an ongoing annual tax. So for some people, the upfront payment will be more attractive to them. For others, the ongoing tax will be more beneficial. So again, I think it's going to be a wait and see as far as what the impact is on homeowners, and which way people actually tend to go in selecting the current model or the new model.
It would seem to my uneducated self that it has the potential to increase those going into the market because it's a substantial saving to enter. But then you would think just on the supply and demand side, if there's more people in the market, then prices tend to go up.
Yeah, I think so. So typically, these sorts of incentives do tend to do that, and it's similar to, you know, the first home buyer schemes that the federal government comes out with, the equity share arrangements, all that sort of thing, increases demand in the market, right? Because people are interested in getting in. It makes it simpler and less costly for them to get in, and that always drives demand. Demand drives the prices up. But when you look at potentially getting rid of a $20,000 to $50,000 upfront fee, that is a significant cost reduction to particularly first home buyers if they're purchasing beyond the traditional caps. So for first home buyers, I think it's potentially a good thing because it helps them get into the property market sooner. From a property value perspective, it may see property prices rise higher than expected. However, that's probably going to be offset to some extent by rising interest rates as well.
Yeah. All right, Matt. And to finish with the perennial question, buyer's market, seller's market, and I'm going to add in a third one that doesn't often get mentioned, or is it hold, keep your powder dry and just wait moment?
Yeah, so I guess it's the old trick of if you don't sell, you haven't actually realized any loss, right? So if your property value is decreasing, if you don't sell, you're not actually impacted by that. I think what we've also got to factor in for property owners as well is the fact that over the last couple of years, property prices have significantly increased in value. And so any drop off that we see as a result of interest rate increases is not going to be the full effect of what they gained over the last couple of years. So we've got to take it as a holistic view. As far as the market itself, I think moving forward, it's going to become more of a buyer's market with the softening of property values. We're probably going to see more property owners probably reluctant to put their properties on the market at the moment. So stock may be a bit of an issue. So definitely, I think it's more of a buyer's market than it is a seller's market, but it's just a matter of whether we can get the stock there for the buyers to benefit from that.
Great. All right, Matt Gatt from Home Loans Manager at Compare Club. Thanks so much for your time.
Thank you. No worries. Thanks a lot.